Hello, everyone, and welcome to today's webinar. It is June 20th, and today's webinar is Section 184 Home Loan Review, presented by Marie Bonville. My name is Alyssa Atkins, and I will be your webinar facilitator today. I am the Training and Development Coordinator for the Native Learning Center. Today's webinar is also being recorded. Just a quick disclaimer before we get started. This webinar provides a summary of fundamental concepts, requirements, and/or procedures within the allotted 90 minutes. The material discussed does not illustrate all possible scenarios that could be applicable. If you look at the top of your screen, you will see an icon of either a person with their hand raised or just a hand. With that icon, you can either raise hand, agree, disagree, or step away. Now your screen should look similar to this graphic here. To the bottom left, you will see a box that says Files. Here you will find today's presentation. Please feel free to download a copy for yourself. Simply click the item you would like to download, then click the arrow pointing downwards, and you will be prompted to save or print the materials based on your device's permissions. The second box that states web links to houses today's survey, as well as any other links that are found throughout the presentation. Lastly, to the right of the screen, we have a chat box available. This is how you will communicate to the instructor and NLC staff if you have any questions during the presentation. Please feel free to interact by using the chat box. Simply type your message and hit enter or click that up arrow icon button to submit. Tech support issues should also be submitted here. It is with a great pleasure that I introduce Marie Bonville. It is all yours. Take it away.
Thank you, Alyssa. I appreciate that. Always a warm welcome from the Native Learning Center. I want to thank everybody for being here today. We've got a lot of content to talk about, and so I know your time is valuable. I did want to start by pulling out all the resources. Sometimes I feel like it gets kind of, towards the end of the presentation, you're trying to get through everything. You want to make sure you answer questions, and then I forget to highlight all the amazing additional materials that are available to you. So I'm going to do that first this time, just kind of get it out of the way. So the first thing I want to pull out is the 5 C's of credit. I'm going to talk about that today a little bit. And when I do, this is the PDF I'm referencing. It's just a few of the slides from a larger Native American curriculum for financial wellness called Building Native Communities through the WISTA Corp. And so I just pulled out those activities that I felt were very helpful as a housing counseling professional. If that's you, if you're in the room and you're needing to, really hit home some of the things that the banks look at, then this is the exercise for you. It's an activity that can be done in groups or individual. I just feel like it's so effective that it's important to bring that up. So the 5 C's of credit, that is available to you. And so I'm going to just highlight that and keep it moving. Next up, certainly we're talking about Section 184 today, and there are several areas that qualify and others that don't. So as you can see here with this map, the areas in red are partially approved, meaning there are specific areas in which you can purchase a home using the Section 184 loan. And then there are areas that are in yellow, for example, all of Florida, all of South Dakota, North Dakota. In that case, you're able to use the Section 184 program in all counties, right? And everywhere in which it is allowed within the state. So that's the yellow, fully approved. And of course, you've got your states that are ineligible at this time. This document was updated as of April 2023, so it's fairly recent. And then so also it spells it out here in terms of the partially approved states where exactly those areas are. So that's helpful as well. Wanted to make sure you had that. And so get rid of this one as well. Okay, while I'm doing that, make sure to put your name and your organization in the chat area if you're thinking about home buying and thinking about using Section 184. You're welcome as well. I like it when there's a good mix in the crowd. That way, if there's something that you want to add, feel free to do so in the chat. We love sharing and hearing from each other in that way. So you all can do that. Let's see here. I've got one more, I think, before we go. I lied, 2 more. So this one was it's a little tricky. Okay, there we go. The closing disclosure. So there's something called a loan estimate, and that is just the giving you an estimate as to what your loan would look like, what your interest rate might look like at that particular time when the lender is evaluating your loan application. So what you need to know about the loan estimate is that it's for your benefit, it's for your client's benefit. So certainly they need to understand the elements within the loan estimate, right? That it's detailing all the things that you would want them to know. So that's a good thing. In addition to the loan estimate, once you're very close to closing, you'll get what's called a closing disclosure. You're supposed to get it at least at bare minimum 3 days before closing. So we definitely want to make sure you're familiar with that. If you're not already, familiarizing your clients with this document, it's very helpful, and it's something I like to go through in detail with the clients. Okay. And then now, last but not least, Section 184 does have loan limits. So what that essentially means is that although there are no income restrictions, meaning a client can make as much money, as far as income is concerned, as they do, right? That's not an issue, which is helpful. I think for a lot of the other loan products that are out there, they have those income restrictions, and so your working professionals in your communities need to be able to have support as well. And so it's great that there are loan no income limits. However, there are limits in terms of how much can be borrowed in any one location. And so this document, also updated April of 2023, gives you those maximum loan limits, right? So, what you would do is just look up your particular location statewide, look for your county, and then within your county, you'll be able to tell, okay, well, for example, let's see here. I've got works for Native CDFI, Yakima Nation Housing Authority. Let's see, Zia Housing in New Mexico. Okay, Linda, if what's your county that you service or that you typically service? New Mexico, and I'll head to New Mexico. Sandoval County. Thank you. Not MN, but NM. I'm getting there. NM. Sandoval County. So that means that your maximum loan amount that could be loaned in the area of Sandoval is $472,030, right? And then, of course, if an individual wanted a duplex, right, or a two unit household, that would be a little bit higher, and so on. And this particular loan does go up to 4 units. So that's just something to note. If you have someone who's entrepreneurial in spirit, then for sure they could have one of those units be their primary residence, and those additional units for family or whomever they wanted to rent to. But okay, great. Thank you for that. I appreciate that. So those are the resources that I have available to you, and wanted to make sure you had access to it. It's located in the file share area, along with all the links that I provided in the presentation. There are a few of those in the web links area as well. So now I'm going to share my screen, and we'll get started with my presentation. So Oista, if you can give me a thumbs up or it's looking good, I'll go ahead and start the slideshow. Alrighty, so hopefully everybody can see my screen. I'm going to leave my chat area up. If you have any questions, you can put them in the chat area. But right now, we're going to talk about Section 184 in a couple different ways. A little bit about me. I started with the Seminole Tribe of Florida, so I'm thankful to be back. I've held a couple of different positions within their education department, and then, of course, as director in training and technical assistance for the Native Learning Center. In that time, I worked with many. It was a blessing to be able to work with different tribes and see how, in so many different communities, the needs are different. Down payment assistance looks different, and the leveraging of resources, to get work done. Some of you are blessed with Native CDFIs nearby, who also provide support. So, seeing that growth of the CDFI network, and how it's supported housing up until this point, I think it'll only continue to grow. So I'm very thankful for that. I currently work closely with the South Dakota Native Homeownership Coalition and other partners to expand homeownership. And I do also have my own residential remodeling and construction business here in the state of Georgia, and it has a realty group associated with that as well. So I am all things housing. I love it. I think it's, no one's born with this knowledge. It's the kind of thing that you build along the way, and we want that for our clients. So this is the curriculum that I tend to work with the most. I love building Native communities because it gives my clients that financial foundation that they need, that they may not have, especially when you're working with adult learners who haven't looked at, these numbers in a long time, or they've been avoiding, right, these numbers for a long time. The other one is Pathways Home. Now this one it's technical, right? Sometimes it can be a little bit difficult because clients are looking at these definitions and they're overwhelmed. But it is important that they have a reference guide, and this does that. And again, it's Native centric. It talks about the different areas and locations and the trust lands versus off reservation. So it gives them the understanding they need. It's just very big. It's a lot of content, and it can sometimes be something where you want to balance that out. So I love to balance them out together. I use them both in tandem. So a little bit about today, we're going to talk about the home loan guarantee program section. We call it Section 184 for short. Introduced in 1992. Of course, it's increased home ownership because there was a lack of access to capital in Native communities, right? And so the argument is, well, how can we continue to promote Section 184? What are the ways that we can let our clients know of the eligibility, the service area, the pre-approval process, the closing process for folks. Many of us, if you're on trust land, then you're building, and that building process looks different, across the country. So we want to make sure people are aware. So we'll talk a lot about the eligibility requirements, the documentation necessary. We'll talk about lender participation, how that works. We'll talk about the home loan process primarily, just because whether you're doing this with Section 184 or any other loan product, you need to know more about that process. And then discussing refinance and foreclosure prevention for sure. So what you may have missed, June is Home Ownership Month. So I've had a lot of time with the Native Learning Center this month, and we've talked about different things. We talked about housing as a market. We talked about, again, some of the things that have happened in the past that have made it, that have put us in the place where we are today in terms of not having access to infrastructure and, not really seeing the housing market like the way we see it off reservation in fee simple terms. The home buying process, we talked about just how does it work? How do you look for a home? What are the professionals in the process? We talked about protecting your investment through selecting the right professionals, right? How do you know the difference between a handyman and a general contractor? How does that protect your investment to use one over the other? We need to talk about these things more. It's a good problem to have. I think that we're in the post-purchase mindset to be able to say our clients need more. So I was thankful to do that. And I think we also included a selling your home, which you may think, well, we're trying to put people in it. Why are we talking about selling your home? But I do think we are in that place and space where now we have put people in a place to make that decision for themselves. So with that, we talked about how 2008 and that particular market had a lack of education. So much of what we do now, it stems from the corrections that were made, but the lack of basic homeownership education is primary. And so now we got way too much information, right? We have so much out there that we're kind of having to evaluate this with our clients and say, I get that you can go to TikTok or Facebook or Instagram and get information regarding a home loan, but what's best for you? Let's use the technology and the tools to help them navigate the process. So that's what this is really about. So as I said before, June is National Homeownership Month, not to not give it credit. And so some of the big announcements, and if you were in any of my other webinars, you probably heard this already, but it's worth hearing again, especially for our Native veterans. So if you're familiar with loan products, then you already know about the VA loan, which means that it's 100%. The individual doesn't have to have a down payment. It's 100% loan. In the case of the Native American Direct Loan, it hasn't performed as much as it should have in terms of servicing Native veterans. So to make it more affordable for Native veterans, it was tied to the market rate. As of, let's see here, March, the interest rates for the VA Native American Direct Loan will be reduced from market rate to 2.5%. So that's huge. I mean, right now, as of today, the 30-year fixed is 7.5%. So that imagine what a difference that's going to make in terms of their mortgage payment. So that's a huge win for Native veterans. I'm thankful to have that news to be able to share that today. And if you want more information, the VA has done a lot to revamp the program and make it more accessible to our veterans. But, you know, I've seen studies where people still aren't familiar with the VA loan, let alone the NADL and how it works, in which case the VA is the direct lender. That's a huge difference between that and the regular VA loan. So it's something that we need to talk about a little bit more, I think, as a community, but I'm happy to share it. We're going to talk about Section 184 a lot today, but I'm going to bring this up as well. Just this July, starting July 1st, and I think the news came out last week or the week before last, but essentially, the private mortgage insurance, we'll get into it if you're not familiar with how this loan works. There is a private monthly insurance that typically is something the borrower pays. It's 0.25%. That is being moved to 0%. So as of right now, as of July 1st, it will be 0%. So they will not have to pay PMI on their loan. And so this is like hot off the presses. I don't have a whole lot more than that information, but I'm sure they'll provide more guidance as to, you know, what this looks like for the life of the loan. But additionally, the loan guarantee fee, which is a one-time fee, is being reduced from 1.5 to 1%. So for my Native CDFIs in the room that do maybe home loans, this is, again, more information that is super exciting. Let's see. Awesome. We've got some family members of veterans in the room. So it'd be helpful to them to know more about that, and then also whether he can apply for Section 184. So I'll definitely get to eligibility. I do believe you have to be an enrolled tribal member for Section 184 specifically. I think with the veterans programming, again, he should definitely look into, if not the NADL, then the VA loan for sure as a veteran. Awesome. Yeah, no, Tiffany says that she's about to start the loan process to construct on the reservation. And so this is a great savings. 0.25 to 0% is a huge savings. We'll actually look at that and what that looks like in terms of a payment here in a little bit. So, you know, I'm thankful. This has been the best month ever as far as information goes. And then lastly, Freddie Mac announced on June 7th that they have a new affordable housing program that they are rolling out as well. It's called Heritage One. It's intended to boost home ownership. I imagine that it's going to look very similar to Section 184 in terms of eligibility. But the idea is they had worked really closely with the South Dakota Native Homeownership Coalition to talk about the issues facing most homeowners on the reservation and the lack of capital. I don't know if you're familiar with the 502 Direct USDA loan, but you know they've worked closely with CDFIs to make them direct lenders. And so the thought is to do something similar, where they really tap into the CDFI world and use your organizations as the reference point. You know, you're in the community working with the clients day in and day out. Who best, right, to do this work? So again, there's more information. You can click that link to learn more. I'm sure they'll roll out more information as it becomes more available to us. But, you know, in general, we are still behind the curve. As of the 2020 census, Native Americans and Alaska Natives were 52.1%. That's our home ownership rate. And this is lower than the national average, which is 65.5, right? A 2017 study from the FDIC showed that 42% of our households are underbanked, right? This is significantly lower than the 70% national average. And then lastly, they also found that these households are more likely to use check cashing services and payday loans and things like that, non-traditional banking services that are not, I shouldn't even call them banking services, they're predatory in nature, right? So we want to keep our individuals away from those environments and really provide them with as much information to build wealth as possible. So when I'm doing this particular programming, what I like to do is start with healthy spending habits. We'll talk about spending and savings, creating a spending plan. We'll go into banks to make sure that they understand how they work. I should put native CDFIs in there. I just didn't have enough space. Of course, we want to caution them about identity theft. They're saving for a home. Right now, a big issue is wire fraud, because now most banks, if you're going to do your down payment, send your down payment, it's through wire. And so we want to caution them on identity theft and protecting their personal information. The heavy hitter is essentially credit, right? Usually this is where, as practitioners, we get the most questions, credit reports and credit repair, and then also mortgages, the types of loans that are available to them, and then the eligibility. Most loan officers are doing the work of saying, this is the one that fits you best. And as housing counselors, we do a lot of that as well. So going back to Section 184, it was designed to create and increase capacity and create capital in Native communities. Our sister communities, the Native Hawaiians, can access the Section 184A program. It's just a different act. Everything's an act of Congress. This is one of those things where it's just a separate programming or separate approval, but it functions very much like Section 184. The Office of Loan Guarantee within HUD's Office of Native American Programs, ONAP for short. They're the ones who administer this particular program. And as I said before, Native Hawaiians can access the Section 184A. Now, the loan guarantee assures that lenders have that they can be repaid, right? That's the big element to this, is that, there is a loan guarantee should the home default, that they have a way of being repaid for that investment within the community, right? So in the event of foreclosure, the banks can get their money back. So first, I know people are usually very excited for Section 184. And when I provide these classes, going back to this process, I typically have guest speakers. I might invite our Native CDFI. I'll invite First Tribal Lending or some other organization, depending on the tribe, to come in and speak about the Section 184 programming. But if your clients aren't ready, if they don't have the mortgage basics, then you're doing them a disservice, because a lot of the language will go over their head. So I provide this information. My apologies if you're a mortgage professional and you do this for a living, but I do think that it's important that they have a really good understanding of the 5 C's of credit. We go over character, which is that credit history. We talk about, what their credit history looks like, what it should look like, or what it could look like if they were to make certain changes, right? We typically have the CDFI pull the credit ahead of time, and that way they're working with their actual credit report. We like to talk about, what is 30, 60, 90 days due to your credit? When you're late like that, what are the kind of effects that it'll have? This is typically where people have questions, because in all honesty, the credit bureaus and haven't done a great job at putting that information out for consumers. And so it's almost so vague that people tell you all types of things to increase your credit score that may or may not be true. So it's important that we give them that knowledge, and we talk about what their character does to their application in terms of their credit history. We talk about capacity, right? That's your repayment, your ability to repay. That's that spending plan. That's creating that space so that you have 30, 60, 90 days saved up, for a rainy day. Not just for a home loan or for a deposit, or your down payment, but to make sure that you don't have to tap into credit, for example, for an emergency. The other thing is debt to income. We call it DTI for short. We'll talk about that a lot, so I'm not going to hit it heavy right now. But all we need to know is that your debt affects how much home you can afford. And so it's really important that they hear that up front before we bring on Section 184 and let them and let the loan officer talk. Capital in terms of personal investment or your ability to repay. This kind of goes back to, how much you have saved and what kind of capacity you have, capital you have to bring to the table. Your collateral, personal values, or, things you own that are of value that you could use, for example. And then conditions. No loan officer is going to provide you with a home loan without employment verification, right? Things of that nature. So, the conditions have to be right as well. What I like to do with this particular group is I like to have them be the bank. I like them, there's in that 5 C's of credit PDF that I provided, it gives you so many different scenarios where you have someone's personal information. You almost feel like you have their life in your hands, which I don't mean that to say that like I don't think that loan officers look at it that way, but they do hear a lot of what's going on in a person's life, right? So a single mom comes in and wants to get a home loan. They're going to talk about that, the struggle that they've had to make their payments, if they can see certain credit issues and whatnot. So it's hard to detach what's going on in life with a loan application, and so the loan officer has both. They've got to look through what you see here in the 5 C's of credit. And although they know what's going on in the person's life, they have to make a decision that's best for the client. And it may not always be to provide the loan. So with that, we talk about what's the difference between a conventional loan and a loan that's backed by the federal government. So going back to banks, I'd like to clarify for my clients, banks are businesses and businesses sell products. And I know that's oversimplified, but the reality is that if we as consumers don't look at loan products the same way we would groceries, then to me, it's no different. There is going to be a product that works best for you. Going back to, I don't have the gentleman's name, but, they have a son who's a veteran, but he may or may not qualify for Section 184. He's going to have to evaluate those loan products, right? And see which one works best for his, one, that he's eligible for, but two, that works best for him in terms of down payment and interest and all of these things. So going back to the loan product, if banks are businesses and businesses sell products, then let's talk about the types of products that are out there. So conventional loan, it's not guaranteed by any federal agencies or entities, meaning the bank is taking a risk. They may, if they were to foreclose on a home, that they wouldn't necessarily recoup those funds, right? It's based on your credit score and your history. So there are no they're not going to remove that threshold from the process. 20% down is a myth that goes along with conventional, that you have to put 20% down. You can put less than, just depends on your credit score and your history. It doesn't always mean that they'll put some sort of insurance on it for having put down less. I think that what you need to know is that the interest rates also fluctuate with the market. So you basically can refinance when it gets a little lower, but it's not giving you any discounts at that particular time when you take this loan out. A loan backed by the federal government is guaranteed by the federal agencies or entities. Now, what does that mean? It means that if the person was to default on the loan, then the federal government has a process by which the banks can use to recoup their funds. Now, interest rates on the loans vary. Going back to the VA loan, which is a market rate. The NADL is soon to be a fixed rate at 2.25%, right? Let's see what others are out there. I know that FHA is 3.5%. So every that's a down payment. The FHA is also market rate, but their down payment is different. So I should say interest rates and down payments vary by loan product. And then they may require private mortgage insurance. Now, when a buyer or borrower has private mortgage insurance, that does not benefit them in any way. It is something that's paid within their mortgage payment, yes, but it's not going towards their principal. It is something that is protecting, again, going back to this loan guarantee, it's protecting the bank. Any questions so far? Let me make sure I've checked the chat area. Awesome. If you have any questions, feel free to put them in the chat area. Going on the types of home loans, of course, you've got conventional, you've got FHA, Section 184, the VA loan, and the Native American Direct Loan, and then you've got USDA, and those are just a few. Qualifying ratios. I don't spend a whole lot of time because I do know that the loan officer is going to, do the actual work of giving them of doing the, I don't want to say dirty work, but they will pull all the numbers and make sure everything is accurate. But I do want to let my clients know what the banks are looking for. So housing expense ratio is also, the other term is front end ratio. What it is, it's the percentage of your gross monthly income that's devoted to housing expenses. So essentially, depending on the loan product, they may require that either between 28% and 36% of your monthly income. That's what your housing payment must include. Like, you can't exceed that amount. So for example, it's easier to kind of describe in numbers. If your monthly income is $5,500 and the front end ratio for the loan product you've selected is 29%, your house payment, right? The payment you make every month, including interest and taxes, cannot exceed $1,595. And that's just 5,500 times 0.29%. Excuse me, 0.29 or 29%. The back end ratio, right? Also known as debt to income. This is a relationship. It's how much debt do you have divided by how much income you make, right? And it only includes the debt that occurs in your credit report. I know sometimes people say, what about my cell phone bill? It's just the things that recur each month on your credit report, including those housing costs, right? So now they're saying, okay, well, what about when we add your debt? Well, your debt will affect the affordability, how much home you can afford. So if you have large credit card and loan balances, your maximum allowable monthly payment will be reduced, right? Because this is a relationship between the two. So what we always expect of our clients and what we talk to them about is think of your credit history as a financial picture. At the time when the loan officer takes that financial picture, it can always get better. It can't get worse, right? You can't go out and start using your credit cards and increasing those balances. You can't go out and buy furniture. We're not there yet. You need to, scale back and actually reduce those balances wherever you can, so that you can afford more in terms of your home itself. So the key definitions is that, of course, I have to explain what is a mortgage, right? I can't jump into Section 184 without that. So it's your loan amount, of course. People always ask, well, what is amortization? And it's essentially a fancy way of saying paying off debt over time in equal payments, right? It starts out where you're paying your interest more than you're paying your principal, but in the end, you're paying and eventually that number starts to increase where you're paying your principal more than your interest towards the end. This is why a lot of times they'll say double up on payments, because of course we want to speed up that process. But it is calculated in equal payments, and that is over, in our case, we typically see 30 years or 15 years. Term is another word for the length of the loan. And then interest rate, of course, is the cost of borrowing money. So you've got your loan amount, right? Also known as principal. There's a lot of words that are interchangeable. And so that's what confuses folks. They might see loan amount one place, they might see principal in another. Term, as I said before, 15-year fixed, 30-year fixed. We, in our world, we don't really mess with ARMs or adjustable mortgage rates. We like to stay where a client will have a fixed loan amount for the length of the loan. Interest rates, of course, the cost of borrowing money, it can be fixed or adjusted, as I said before, but we don't really do that in affordable housing. It's just too risky for our clients. What is included, and having experienced it personally in 2007, going into 2008, I wouldn't wish that on anyone, to have your loan payment jump up double or triple what it was. So going back to what is included in your mortgage payment, I definitely want to make sure people understand it's principal, right? It's yours. I like to talk, I give them examples and I'll say, every time you make a payment, you've got two pockets. You got a pair of jeans on, you got two pockets. Principal, that money is going into your pocket. That is your money that you're investing into in yourself. That becomes what's called equity, right? I also talk about the interest. It's not, banks are businesses have products, they're in it for making money as well. And so the interest is the money cost of borrowing that money that belongs to the bank. So yes, you are always paying the bank when you make a payment, but you're also paying yourself. And that's a good way of thinking about it, especially if you've got folks that are kind of huffing and puffing and not too excited to make those payments. Think about it like that. Now, if you're off reservation, then you're also paying taxes. And so that's a little bit of that is included in your payment. But always, if you are, whether you're off reservation or on reservation, you are paying insurance. This insurance, if you don't elect to pay insurance, it will be forced upon you. Banks require that you have insurance in order to have a home loan. That's just the nature of the work. They want to protect that asset until you're done paying it off. And then when you're done paying it off, you should still carry insurance because you want to protect that investment for yourself, right? As the homeowner. Next, we have our down payment. And I also have to clear this up because a lot of times our clients feel like the down payment and closing costs are the same thing, and they're not. So clearly, we have to do a better job of explaining what the down payment is. And that's the investment that the lenders want to see the borrower have. They have to have a certain amount of money. Different loan products require different amounts as a percentage of the home loan itself, but they do require this investment, and that investment is the down payment. You'll see in the loan estimate how much your down payment is supposed to be. And then, of course, with closing costs, I'm going to just rattle these off here. You got a loan application or origination fee. You got a credit report fee, home inspection fees. It may not be in it's something that should be assessed, thought about, but it may not be in your loan estimate. Appraisal, that'll be in your loan estimate for sure, because that's a fee that is going to be charged by the lender. Points. We don't really talk about points a whole lot. That's more of a conventional thing, but I will explain it in a couple slides here. But yeah, all of those additional monies that need to be brought to the table, that happens. That is considered a part of closing costs. Document preparation. This could be something that the title company is charging, or depending on the location where you live, it might be an attorney. Mortgage recording, if you're going to have to if you're fee simple, for sure, the county is going to need to record it. And so you'll have that. And then sometimes there's infrastructure costs, right? You've got water, sewer, electric, gas, those sort of costs may be included in that. You might also see there will be credits. You'll see that on your loan estimate or closing disclosure, when it gets time to look at, whatever down payment assistance you might be receiving as well. But although we love to see credits, closing costs are about debits, right? They're the things that you will owe. And we don't want anyone to have to come to closing and not be prepared and not have the monies necessary to close, right? So that's why it's so important to know what is required of you as the buyer. So one of those things is understanding loan to value. The way I like to describe this is no bank will lend you more than a home is worth, right? And you could see with home prices right now, well, they shouldn't really have that issue. There's tons of value in homes, but it's important to understand how it works in terms of percentages, right? How much is my down payment versus my home loan? So in the case of Section 184, that down payment is 2.25%, right? So if that's the case, then that means that the borrower is only going to provide 2.25. The lender is going to provide 97.75. So if I look at that relationship, you can see that it adds up to 100%, right? The loan to value for Section 184 is 97.75%. The down payment is 2.25%. So to use easy math here, $100,000 times 97.75 means the lender is doing the heavy lifting and lending 97,750. The down payment that the borrower needs to bring to the table is 2,250. That has nothing to do with closing costs. That is a completely separate amount of money that they'll have to bring to closing. So we got to break those things apart and make sure they're aware so that they're not short. If this is in some environments, I'm working with clients that are where Section 184 is great, but maybe conventional is something they've looked into as well. Specifically, I'm thinking in California, there are a lot of borrowers there that I've worked with, native borrowers that could go conventional or have chosen to go conventional as well. And part of that is because they can do what's called a buy down. Now, what this means is that they're taking the interest rate at whatever the market rate is at the moment, and they're buying it down. They're reducing their interest rates so that their payments can be more affordable. And so for those of you who have clients that have the means to do that, let me explain how it works. On a 30-year fixed rate, let's say it was 6%, right? A buyer could pay 1 point, and then it would get reduced by 0.25%. Now, I'm going to be completely honest with you and say when I first heard 1 point, I thought, okay, cool. That means it'll get reduced by 1%. No, 1 point is reduced to the rate of 0.25%. So now 1 point is 1% of the loan. So let's go with some easy math. You have, and I know there's no houses out there for $100,000, but for the sake of this argument, let's say our interest rate is 6%. I have a $100,000 loan. 1% of $100,000 is $1,000, right? So I would pay $1,000 just so I could get it reduced to 5.75%. Does that make sense? I hope it did. I probably should have put a slide in there, but we don't really work with buy downs in affordable housing in most reservations. So, but if you do have a client, get familiar with buy downs because it could be helpful as a cost saving measure if they have the ability to do that. So the question in the chat is, do we pay closing costs at the time of closing or finalizing the loan? And the answer is yes. Typically, when you go to settle at your closing, whether you call it a settlement or you call it closing, you're basically going to go with those funds in hand. And when I say in hand, I mean wired or in a check form or something like that. Typically, that's how it's done, is that everything gets settled at that time. You'll give if you're the borrower, you'll give those monies over to the title company or the escrow, whoever's holding the money for you all in the transaction. So how much home can I afford? That's what most people want to know. That's what they're here for. And the loan officer assesses the ability to make payments. I know that there's tons of calculators out there that do that type of stuff, but I will say you open yourself up to people who may not be familiar with Section 184 when you do that. Think about when you think about buying something online and then all of a sudden you say you're going to buy something or that you need something, and then the next thing you know, it shows up on your phone or it shows up as an ad. When it comes to housing as a market, it's very aggressive. And so you will find that people will Google Section 184 and then lenders start connecting with them, or maybe even they pull they go ahead and get their credit pulled in an effort to kind of clean it up before they get a loan, and they start getting hit up by lenders. And so it's really important to kind of let the loan officer that you choose to work with be the one to assess your ability to make payments and talk and give you those numbers. Of course, they're going to assess the 5 C's of credit. They're going to look at the front end ratio and the back end ratio. So as I said before, be careful with looking up mortgage rates and calculators, because sometimes you might want the interest rate for the year, or the average or whatever. In this case, every day mortgage rates change. So it's not directly tied to the Fed rate. It's something that adjusts over time. So even when you see like a headline that says that the Federal Reserve has adjusted interest rates, that doesn't mean the mortgage rate is going to change overnight. It takes some time. But as I said, when you Google these things, as you can see I did here, tons of different lenders will open up. And as you can see, the top 3 things say that they're ads. They're not actually, sites where I can go and just get that information. I might have to sign up or sign in or provide information to get that information. And that we don't want you to have to do. So I'd say I've got native CDFIs in the room. If you're providing housing counseling or any sort of financial wellness, you want to let your clients know that you're willing to provide that information for them or get that information for them if they need it. The loan estimate, as I said before, is a great tool and one that you'll have to use with your clients because, of course, they need to know what documentation that you'll need from them. So in the case of Section 184, and I think this one is a generic one. Section 184, I have another slide for that. But typically it's the same. It's your pay stubs, hours worked. Of course, they're going to look at consistency. So, if you've got a lot of overtime, they'll have to take the average on that. Irregular earned income, so overtime, commission, bonuses. Of course, any debts that you might have, child support, garnished wages. Something we see, in tribal communities is maybe loans through the tribe. Which also need to be taken into consideration. So just being mindful of that. Some folks feel like, well, it's not being reported on my credit, so it doesn't always apply. And in this particular case, it does. Bank statements, direct deposit, Social Security, pension, all these things, they are looking at that. What you want to avoid is below. So large deposits, they want to know where it came from. It's funny. I worked in South Florida. And so, not to say that there isn't funny money everywhere, but the reality is the bank wants to know how long has that money been in the account and where did it come from, right? So sourced, they want to know where it came from, and seasoned, how long has it been there? Non-sufficient funds. Non-sufficient funds are important because a lot of folks think they're just looking at credit, and it's not just that. So there is the check system, which is a consumer reporting agency for your banks, similar to Experian or Equifax. What they're doing is checking to see, how many overdrafts has this person had, fees have they accrued, over a 12-month period. And so that may also play into what's going on with your ability to get a home loan, right? So be careful with that. And then any other debts that you might have. Lastly, tax returns. You've got self-employment, any losses. I know if you're a small business, you don't want to necessarily, what's the word I'm looking for? Claim how much you're actually making. Part of this is it's a delicate game when you're self-employed, and I am self-employed, so I do understand where if you want to try to expense out as much as you can and show that, hey, these were all business expenses. The problem with that is that when you have those kind of losses, then it doesn't look like you've made enough to afford a home. So if you're going through this process, when it's tax time, you have to have a conversation with your tax professional as to what is reasonable in order for you to qualify, right? Because if you're showing that you've got losses each year for over 2 years, then you're not going to have any income to show. Unreimbursed business expenses, changes of business structure. If you own a business with someone else, that could play into things because they may need additional information. So it's just one of those things where you want to be mindful. I'm not a tax professional, but once you decide and you make up your mind to become a homeowner, these are the kind of things you're going to have to think about. So, this presentation is going to get recorded. I appreciate the kind words, and for sure, a copy of the presentation and the recording will be available as well. So thank you. Moving on from documentation, we have to talk about pre-qualification versus pre-approval. What's the difference? I've got the words here, but I'm a visual person, so I'm going to go with the Cliff Notes. Pre-qualification is an estimate of your income, estimate of your assets. They might do a soft pull, which means that it's not going to affect your credit in the way that pulling your actual credit score would would mean. Verification is not required of employment. That doesn't mean they don't do it, but they may be looking at your bank state, at your W-2 or your check stubs and looking at that and saying, okay, that makes sense to me. And they won't go further and actually call your employer. The other thing is, if it matches up with your bank statements, and then it makes sense to the loan officer, and they may not move forward with verifying. And then, of course, liabilities, they'll say, well, any other things that you owe, and they'll just take your word for it in terms of, this idea that you're trying to just estimate how much home will I afford, or will I be approved for. It's a good first step, but it's definitely not something that, as a realtor and someone that works with, when I'm on, let's talk fee simple. When I'm off reservation and I'm working with a client, I would much rather they be pre-approved. And I'll tell you why. You look stronger to a seller when you are pre-approved. That means you've gone through the process of actually pulling your tax returns, verifying your income. You've actually looked at bank statements, and we know that, what you are what you say you make, you actually put it in your bank each month, and we can see those assets. We can also see, those habits, that history. We don't see any non-sufficient funds, etc. What else? We can see, we're going to do a hard pull, and we're going to verify everything, get you through underwriting, which is essentially what this means. And so pre-qualification, if you're just thinking about how much home I can afford, you can get a pre-qual letter. And then that way you can start shopping for a home loan. You can start looking at manufactured housing. You can start doing these things. However, you will have to go through an actual pre-approval process. And so this is where the underwriter comes in. We talked a little bit about the 5 C's of credit, where I said, poor loan officers got all this information, both in black and white in terms of your numbers, but then also they know that personal history, right? They know that you're a single mom, or that you just started a small business, or that you and your spouse are wanting to purchase your first home, and they're just as excited for you, because typically first-time home buyers, it's like just such a great thing feeling wise, that the loan officer never wants to say no, right? The banks understand that, and that's why the underwriter is so important. So I'm not dating myself. Everybody loves The Wizard of Oz. And so you remember, like, the man behind the curtain, like, pay no mind to the man behind the curtain. That's what I'm trying to get here, which is that the underwriter has to have a arm's length experience. They don't connect or communicate with the homeowner. To be honest with you, most of the larger banks are using an automated underwriting system. So it's actually a computer pulling the numbers, making the decision, looking through everything and making sure. Is there an actual person paying attention to things? Sure. But the underwriting process, there is a technicality to it. It is not looking at personal information. So there is a question. Mobile homes do not qualify if they are in a mobile home park, right? So depending on where you live, like, it can be moved. It has to be on a permanent foundation. So that's the thing with mobile homes. Depending on where you currently have it parked, if your mobile home has a permanent option, like if there's a way for you to keep it that way, they may be able to make an exception for you. I'm not entirely sure. That depends on the mobile park. But if they're a mobile home park, they may not allow you to. In terms of the Section 184 loan, it does have to be on a permanent foundation or structure attached to. Awesome. Did I miss anybody else's question here? I think that might have been it.
We got 2 questions, Marie. You've got one from Linda.
Oh, sure. So repossession of a car. So it would be on your credit report. This is something that it's derogatory in nature. It will be looked at. They'll also look at the year, how long it's been since that repossession. It's not like bankruptcy and what's the other one I'm thinking of? Foreclosure. Those are specifically defined. Will they take a look at that and decide, if it was fairly recent within the last 6 months? They may say it's not a no, but a not right now. And, maybe have you work with the creditor to, settle or do something along those lines. But in terms of allowed or not allowed, it's not as clear as foreclosure and bankruptcy. There are specific timelines. And I can definitely check with one of our loan officers that I work with to double check as to what that would look like for them. But it's my understanding that, each person's financial circumstances are different. And that with Section 184, the good thing is you're not looking at an underwriting system. You are actually, it's a manual underwriting process. So the individual, can look at your circumstances and make a decision based on that. So the loan decision itself, once the underwriter has decided, let's say that they've approved the loan, then you get what's called a clear to close. Or you'll get a clear to close with some conditions, right? They may say, we think your application is great, but you know what? We need you to correct your taxes, or we need you to pay off this particular debt. There's a lot of different reasons to get a condition. I've got housing folks in the room, so I can say this. You know how your policies can always be more restrictive than HUD or ONAP, but not less than. In the case of lenders, you can always, of course, you have to go with the minimum guidelines as far as approving an applicant. But you can always provide what's called an overlay or some other condition to closing. That's best for your organization or your financial institution, right? So that's what I mean when I say that there could be a clear to close, meaning you're good, or it could be a clear to close and you've got some things you need to satisfy first. So now we've reached the point where it's no longer a loan estimate, but it's a closing disclosure. This form is a statement of a final loan term and closing costs. Compare this document with your loan estimate. So it clearly states that you should be able to see, for example, at the time when, and of course this is a while ago, so 3.8 is very low. In the case of, where was I headed with that? Oh, so in the case of the closing disclosure, you can see that maybe they haven't locked your rate. With Section 184 and most banks that I work with, they lock them within 60 days of your home loan. So whatever the interest rate is at that point. But let's say you're in South Dakota and the building process takes forever. And so you started this process a year ago. Well, then, yeah, the interest rates might be different than they were. There's a question in regards to, I thought I saw it. Where is it? Points. So those are optional. But they may not always be an option for guaranteed loans that are through, for example, FHA may allow it. I don't think Section 184 allows points because it's already got other elements to it. But I guess that just depends on the lender. We had a clear to close and you go and apply for a Kohl's credit card. So what does that mean? Well, people get excited when they're in this process and they tend to think, well, now that I've gotten a clear to close, I can quit my job. I can go to Kohl's or I can go to Rooms to Go and buy furniture or Maynard's or wherever. Like my argument is protect your buyers, let them know their financial picture cannot change. It can always improve, meaning you can always, pay off a credit card, and that's a good thing. You can always, reduce debts, but you cannot go out and make large purchases on your credit card that are, out of the norm, right? If you pay Netflix each month and then you pay it off, that's something they already accounted for. But if you're out there spending additional monies, they are going to question it. And I have had it happen where people were asked day of, they verified employment the day of. So there is no quitting right before you close. So the key to closing on time is keeping the communication lines open, avoiding applying for new credit, avoiding late payments, avoiding new furniture, like I said before, or irregular deposits, no funny money, quitting your job. Now, where are interest rates now? Our buyers ask, is now the time to buy? How's the market? All of that. We're going to talk about Section 184 in regards to that. I did say that it's a part, that it is a market rate. So let's look at that. Here's from 1975 to 2022. Here's the list of what interest rates have looked like. So when people are saying that, well, I don't know, I hear that interest rates are high. They are higher than they were a year ago, but trends are what they are. Like in the 80s, there was high inflation, high interest rates. The 90s, the early 2000s, you saw it drop dramatically from the 1990s to the 2000s. And even after the 2008 crash, well, certainly, the government wanted to put more money into the economy and grow our economy out of that situation. And so interest rates were low so that people could borrow money and buy homes. 2021, I should say, is the lowest on record. And that is because of the economy and the situation with the pandemic. So where people are concerned about payments and affordability, I can completely understand, but we have to also take into consideration that these were unique circumstances. The biggest thing for me is if someone had a Section 184 loan in 2014 and they had a 4% interest rate, did they know to refinance in 2021? Right? I want to know from an education perspective, how do we connect with our buyers, our homeowners, and make sure that they are aware of what could benefit them in the long run in terms of their interest rates and refinancing or, along those lines, protecting that investment. Going back to Section 184 basics, as I said before, this is the areas that you can use the loan product: fee simple or fee land, tribal trust land, allotted trust land, and restricted fee land. So what do I mean by that? Of course, trust lands is the most common in Indian country. Legal titles held by both the federal government and the tribal government in common. This means that although it's managed by the tribe, its oversight is through the BIA. You have to get what's called a tribal status report issued in order to sell that home. Individuals can hold parcels. That's called allotted. I'll kind of show you something that explains allotments because it can get complicated. But essentially, this land cannot be conveyed or sold without the consent of the BIA. Of course, it makes it more difficult, but this is why you're issued what's called a lease on trust land so that that's pledged. Going back to the 5 C's of credit, it's considered collateral at that point to be able to say that this is the security for the loan. And then leasehold mortgages are the main vehicles that lenders use. So depending on where you live and the tribe that you're working with to get this done, those could be 25-year leases, 99-year leases. I've seen, different numbers for different communities. Restricted fee lands is another version of that. It just means that it's held in, it could be the legal title itself could be held by the tribe or an individual, but the land is still subject to restrictions or sale without that approval of the BIA. Fee lands, it says it's simple. We call it fee simple because it is. An owner owns that has title to that land, and they can sell it without any federal approval. And so the home itself is the collateral for the mortgage. When owned by a tribe, this is where it gets a little complicated, or an individual, but it's in the boundaries of a reservation. So, for example, a tribe purchases a parcel of land, well, then it's subject to tribal jurisdiction. And so here's kind of the image to convey what allotments look like. It means that it's held in trust. It's owned by an individual tribal member. When that person passes, especially if they don't have a will, well, then, it gets broken up. That ownership right gets broken up amongst the family members. Now, even though they're not able to sell that land itself, those individuals still have interest in those lands. You typically see this in Oklahoma and other areas where allotments were provided. Sadly, many allotments now have hundreds, if not thousands, of individual owners, make the process of selling that, of putting a home on allotment lands a little more difficult. But there are partners in this process, and this is why, as complicated as those things sound, you have your EWONAP partners, you have lenders, you have tribal communities, you have tribal housing authorities, or you have your departments that are working on this day in and day out. So why should I use Section 184? Because it's 2.25% on loans over $50,000. That down payment is very affordable for most folks. If it's under 50,000, let's say you're going to maybe you've got a permanent mobile structure that you want to use, then it's 1.25%. So even lower down payment. It's based on market rate, not an applicant's credit score. So going back to a conventional, there's a clear difference there. The conventional is using your credit score and your credit history. Here, the underwriter is looking at your credit history alone, not the score. Again, manual underwriting, now we can see how important that is to this process because they're looking at different issues, different access to capital, right? You might not even have credit. Some of our individuals some of the underwriters or loan officers are looking to other non-traditional forms of credit to be able to approve someone. So that's the beauty of Section 184 is that it's definitely Native centric. It's meant to increase the number of homeowners we have by looking at the circumstances and making exceptions. You have to be an approved lender through HUD. Like you can't just decide as a lender to provide the Section 184 loan. You have to go through a process. This upfront guarantee fee that I was telling you about, again, it went from 1.5% to 1%. Let's see here. Again, there's no adjustable mortgage rates for the Section 184 program, and it's to protect folks from predatory lending. Are all ARM mortgage rates bad? No, but just it's not good for our borrowers. Not something we would advise. A knowledgeable staff, of course, we want to make sure that both through the Native CDFI networks, through HUD housing counseling, which I know is something new and coming to Native communities, that all of these things are going to help to ensure that we as the staff know how to assist their clients. And going back to those changes, you've got the monthly private mortgage insurance going from 0.25 to 0. You've got the reduced loan guarantee fee. So what does that look like in numbers? If you have a $300,000 loan, look at your down payment. If you're using Section 184, your down payment is $6,750. If you're using FHA, that's $10,550. So that you can see that's a huge difference for our borrowers. So that's a great highlight there. In terms of the government fee and that reduction, the FHA rate right now is 1.75%. HUD's just moved ours from 1.5 to 1. So now you're looking at $2,393 as opposed to $5,000, right? So, that's the difference 1% can make. Oh, and then last but not least, PMI. PMI is typically not a large portion of your payment, but it's just one more cost. And so if you can save $135, do it. So we are going to talk about contingency costs. I think that's coming up next. Who's eligible for the Section 184 loan? That's your Native American or Alaska Natives enrolled in federally recognized tribes. Tribal housing departments or TDHEs can also purchase property using Section 184. Typically, they tend to use Title VI as well, but Section 184 is available to the housing department or TDHE. Of course, the tribe can always purchase as well as an entity. We do have tribal housing departments that utilize this funds. And then Native Hawaiians access Section 184A. Highlights. So the big driver is that there's no income limits. We're talking about our working professionals, our essential workers, right? Our nurses, our doctors, our police officers, they need a place to stay too. And I know that when we're in the world of affordable housing, you don't always have options for them. It's not credit score driven. So they don't have to have a score that will, affect their credit. It's the history, right? No private mortgage insurance. It's down to 0. I don't know how long that'll last. Flexible underwriting. You're not getting a computer. This is an actual person doing it. Low down payment, 2.25%. I showed you what FHA is. Conventional would be even higher. So that's affordable for most of us. This is a big one. Debt to income is 41%. That is huge. The industry standard, and someone else can chime in the chat area. I think I have some CDFI friends in the room. I want to say the industry standard is 36% or 38%. When you're looking at a conventional loan, it's pretty strict. how much debt you can have. 41% does make it easier for us to qualify our borrowers. So that's a good thing, because I want to say that if you were going conventional, you'd have to have a lower DTI. It would have to be close to 36, 38%, somewhere in there. And as I said before, debt to income is that financial picture. What do your debts look like versus what is your income? So let's see here. I talked about where you can find out who's eligible and where you're eligible. So that's a good thing. Purchasing an existing home. So first and foremost, if there's a home on the reservation or there's a home that you're interested in that's fee simple, those qualify, existing homes. Construction of a new home. So that could be site built. It could be manufactured homes, but it has to be on a permanent foundation. And so again, going back to that mobile home, that would have to be the case. Rehabilitated home, including weatherization. So if you have an existing home and you're wanting to do pull a home loan to be able to fix it, sure. You can purchase. So when I say rehabilitate a home, I mean an existing home, or you can purchase a home and then fix that home as well. So we do have it where it's kind of like you start the process with getting a home loan and then you add that rehab to it. Section 184, you can refinance, going back to those individuals who maybe got a higher interest rate. Well, if interest rates were to ever lower, they could always refinance. And then Section 184 can be used for single family 1 to 4 units, just like the chart shows. So construction loans, going back to the question that I had in the chat, it's flexible and easy, but it does take time. And you do have to understand all the elements to building a home, right? The infrastructure itself, working with your land office to make sure that you have your TSR and everything needed on that front. But essentially, yeah, it can be used to build a home. Now, one of the impediments to construction is the contingency. And so what that means is that HUD isn't doing any upfront payments to the construction company. They are going to do a schedule of payments based on the work performed. So the work has to be performed in order for them to move forward. And of course, you can use this to rehabilitate, renovate, remodel, or expand a home. But the major benefit is that it's one closing. So you're only having to do that once, whereas in some cases, you've got what's called a second closing. So your permanent rate is locked in, at the time of closing. But constructions, again, going back to contingency, first you have to make sure that the contractor is qualified through HUD. So you want to be pre-qualified for the amount needed. So you'll have to get the scope of work from the builder, the estimates from the builder, et cetera. Then that builder also needs to be approved by HUD to do the work, right? So that's a process. The builder has to contact the approval process. So let's say they finish the foundation. Well, then HUD will have somebody come out, inspect the property, and then issue a portion of that payment. 90% of that work will get paid out. There is 10% that's held in contingency for each section of the job. And then at the end, after the work is complete, the builder they'll release that last 10%. So going back to construction, that's the contingency cost that you had a question about. Are there loans that offer down payment assistance? So the loans themselves don't have, I guess when they lowered your down payment rate, right? So going back to the loan to value, when you look at Section 184, you see that it has a low down payment. So in that way, the loan is providing you with relief or assistance. Now, your tribe, your community, your CDFI, they may have down payment assistance opportunities that are available to you. So in that way, you'd have to check with your local providers to see what kind of down payment assistance is available. Typically, first-time home buyers, your housing agencies have funds for that. It will require some sort of education component. You'll have to get like a HUD housing counseling certification that says this person has gone through, classes. And then at that point, you qualify for some sort of down payment assistance. But down payment assistance programs are out there. I do know of a lot of tribes that provide that for their folks. I know CDFIs are also looking at that as well. There's a lot of monies that have come to us post COVID to provide assistance. So I would definitely reach out to your local CDFIs, your local loan officers, individuals who know what's going on in your particular area, that might know of the down payment assistance options that are out there for folks. Um, and so, no, they're not deferred loans. There may be some sort of, what's the word I'm looking for? So when you have a down payment assistance program, they're usually forgivable, meaning as long as you don't sell the home, then you don't have, there's no repayment to the down payment assistance itself. Going back to the features of the Section 184 loan, it's a 30-year or 15-year term. It's a fixed interest rate. There's that 1%. I keep mentioning the 2.25 down payment, no adjustable rates, no commercial structures. So if you're in a rural area, I know sometimes folks think about, cattle and other things. And so just as a side note, there are no commercial structures or elements to this. Someone asked about repossession, and the fact that it was a year old is good. 12 months is typically what we say. Like, we'd like to see positive credit improvement. 12 months or more. So the fact that it's a year old is good. And it'll only get better because that's not going to happen again, right? So foreclosure has to be at least 3 years old, bankruptcy at least 2 years old, court ordered judgments or liens that may affect the borrower's ability to repay. I think repossession is kind of can fit in that area where it's something that's going to get reviewed, and then they'll let you know as to how much longer they think it'll be before that no longer affects your ability to borrow. It may not have an effect if your debt to income is where it needs to be, if the ratios look good, if that's the only negative thing being reported, you might just, they may make that decision to move forward with the loan. No credit, then they look at trade lines, right? So they may say, okay, well, what do you have that you've been paying monthly for 12 months? And so it may not look like traditional credit. As I said before, Section 184 has the manual underwriting element. And so it's never a no, it's a not right now. They do look at the fact that they can use non-traditional credit, right? So it's not credit score driven. Make sure you're current on monthly payments within the 12 months that they're the snapshot. Current mortgage payments. So if you're getting a refinance, then your current mortgage payments need to be on time as well, right? They're not going to necessarily want to refinance if you're already struggling with what you currently have. Collections must be paid in full. This is new. It's my understanding that it used to be where as long as you were making payments to collections, they would allow it. But now they are saying that collections must be paid in full. This kind of goes back to, well, it could be that that particular lender I spoke with, they're requiring it. It may not be a Section 184 thing, but an overlay. So it just depends. Income, salary or wages, overtime and bonuses, commissions, and seasonal and part-time work. So of course that's income, but you got to remember, especially if you're overtime or your bonus or your commission driven, they're taking the average of those 2 years. And not only that, but let's say you did really well year one and you made more than year two. Well, they're going to look at the lower wage amount because they have to, assume the worst. Income. So other sorts of income, of course, you've got retirement, alimony, child support, rental, self-employment, tribal distribution. So very similar to what most of the industry standards are in terms of income. This tribal distribution is one of those elements that we see in our communities. So we add it, right? But you want to avoid impulse purchases. Try to be strict when you're in this process because I feel like the moment you start to get your life together, there are a million advertisements that start to hit your inbox. Funds to close, you need to have, of course, your savings and your checkings. It can be in there. Secured funds. Gifts are allowed. Now, I know with FHA, it's a certain percentage. Like it can't, the borrower has to have the down payment monies. And so, of course, the down payment assistance or wherever they're getting their funding from cannot exceed, they can't use it for the down payment itself. That has to come from the borrower. But that's FHA. For Section 184, I do believe gifts are allowed. And so now they will require that there's some sort of letter or attestation. Is that how you say that word? I think so. It basically just means that somebody has to confirm in writing that it's a gift and not a loan, right? So cash, they don't like to use it, but they will if they have to. And land equity, of course, if someone owns land and they want to use that, they can sell that and use the equity from that for sure. Sale of personal items, you'll see that as well. People can sell things. Sale of home proceeds, that goes back to being able to sell a previous home, purchase a new one. Maybe they're upgrading. 401k loan. They don't like to see 401k loans, but they do see it happen. So it is an option. But that goes back to financial wellness and having a nest egg and having that security. And so no one wants to see you use your 401k, but it is allowable. Sale of investments are allowed as well. If the tribal member has something that's a value that they want to sell, maybe a business or something like that, go ahead. And then that down payment assistance, as I mentioned before. And every down payment assistance program is different. Some people will say it can be used for everything, down payment, closing costs. Some people will say it can only be used for closing costs. It really does depend on the provider. The loan application. So let me make sure. Yeah, I'm good on time. The loan application itself can be completed. Most lenders do things online nowadays. Of course, there's a paper and pen application as well. But both borrowers need to provide documentation. That's a big one because a lot of times, in my household, I'm the paper person. I'm the, if it comes to an application, I'm the one filling it out for my husband. And so I need to have but he needs to provide documentation as well. Like it can't be one-sided. You're on the loan, but you're not providing the documentation. It doesn't work that way. Paycheck stubs, you'll need at least 1 month. W-2s or 1099, you'll need 2 years of those documentation. Tribal ID, driver's license, government issued ID, and then the bank statements, 2 months. I had a loan officer once that, the moment I had a client that the moment she saw that her bank statements were ready, she would just send it to him. Like she didn't even wait. She just said, okay, he's going to ask me for it. And so that's one of the things we have to kind of prepare our borrowers for. Buying a home on the reservation takes time. Typically days on market in a fee simple situation, you're looking at anywhere between, especially current markets, 30, 45 days, maybe 50 days, if something goes wrong with the loan. In a tribal environment with that many different agencies that we're working with to get the deal done, we haven't even discussed infrastructure or IHS or any of that, if that's needed. So it could take some more time. So you might start the loan application. If you're in South Dakota and you start the loan application in January, well, it's the dead of winter. Even if you get approved and everything's good to go and you've selected everything and the infrastructure is already there, you can't build until March, April, May at best. So thinking about that, helping walk your clients through the timeline is helpful. But they should submit their loan application. And so these tips come from a loan officer. Be careful with large deposits because, again, that's sourced in season. Transfers is another big one. Now there's Zelle, there's Cash App, there's all these different ways that we can, get quick money to and from each other, but you need to be careful with transfers. Large dollar amounts as far as overdraft fees could hinder the loan process. Remember, they're not looking at your score, so they've got to look at your picture. And what does it say if every month, you're not able to cover all your bills? Monthly debt for student. So if you have student loans, right now the requirement is that they look at 1% of your total loan amount. So student loans are looked at, just not in its entirety. But at least 1% of that balance is shown as a part of your DTI. And then you must be able to document where you've lived in the past 2 years. So this one is also important because I think, when we're trying to avoid certain things like payment shock, we the lender wants to know this information because they don't want to give you a loan and then a year later, they can't come in contact with you. They don't know where you are, etc. So going back to things that I don't know if this is considered an overlay. I mean, I've heard it said several times in regards to payment shock. Payment shock itself is the difference between your current rent or what you're paying now for a house and a mortgage payment. So like in the most extreme case, let's say you're living with your mom, so you have no house payment. And then all of a sudden you're able to afford $1,000 mortgage payment. Well, the argument is, do you have at least 6 months saved? Because it still may be very difficult for you to get there, to go from no payment to $1,000 payment a month. I think that there's black and white, and then there's reality. And so when it comes to the default rates with Section 184, one of the things they noticed was the fact that borrowers who did get in trouble, they had a pretty good gap in their payment shock, right? It was like they went from 0 to 60 real quick, and they couldn't get those payments made. So a bank may require, so it's not all banks, but in the case of the one I spoke with, they'll require proof of as much as 6 months savings to cover going from no living expenses to a mortgage payment. So that's payment shock in a nutshell. It may not be across the board, but with one of the largest providers of Section 184 that I spoke with, they account for payment shock. They also may want to highlight or make sure that people understand that you need to show documentation in terms of your tax returns, and make sure you don't owe anything. Going back to some people will say, okay, well, I'll spread that payment that I owe them over the next 2-3 years. Well, if you're in the process of getting a mortgage, you might want to go ahead and just pay that off. And then if that's the case, now you have to go back and get that confirmation that it's paid off, which could take, again, more time. So let's say the lender looks at it, sees that you're making these payments, but it's affordable and you have money in your savings, and they tell you that you need to pay it off. Well, now you need a letter certifying that you've paid it off through with the IRS. So just being mindful of that, because it does hold up the process. So these are the tips that they gave me. And then lastly, if self-employed, then provide the full tax returns for at least 2 years, as well as current year profit and loss, right? If you're if you're a business owner and your profit and loss statements consistently show a loss, well, then you're not necessarily going to be approved for much. Then lastly, escrow accounts. I wanted to mention the fact that no lender, as I said before, will lend you money for a home without insurance on that home. So when you make your payment, a part of there's a separate account. It's called escrow, and essentially a portion of your payment will go to insurance and taxes for the year. And then the lender will go ahead and make those payments directly to those individuals, right? The insurance company, and if you're off reservation, then your county or your municipality or whoever you need to pay your taxes to, they'll do that for you on your behalf, because they really don't want to see somebody have some sort of interest in the property outside of themselves and you. Right? So that's what it means when it says insurance. If you don't have insurance, it will be forced upon you by the insurance company, by the lender. And then also too with taxes, as we saw before with bankruptcy and liens and things of that nature, they don't want another party being interested in the property. They want to have first right to that property outside of you as the homeowner. So how do we help our clients? We got to stay informed. Most housing counselors have 3 individuals from each profession, 3 realtors, 3 insurance providers, 3 loan officers. So that way they give their clients a balance. Of course, we may have our preferences, but we want to make sure we're giving them options. This is about generational wealth. According to a 2021 report from the Urban Institute, 70% of all generational wealth is real estate. So what does that mean for most families? That their home is their most valuable asset. You get it in a couple forms. First, it's tax breaks, right? Homeowners deduct mortgage insurance and property taxes if they're off reservation. What else? Borrowing power, right? They can get home equity loans and lines of credit. And in the case of in the case of our homeowners that are going to, our predatory lenders to get things done, like fix their roof if there's a repair that needs to be made. You definitely don't want that. They can tap into the equity that they already have in their home, go back into their pocket and just get it out of the house that they have. Increase savings, right? So homeowners are more likely to save money because they want to maintain that property. So that's also a big deal. And then increased financial security by way of financial hardship, right? So let's think about it. When you're late on your rent, your landlord starts to knock on your door 30, 60, 90 days, and they may choose to evict. There's a process to it, but in the case of a homeowner, banks don't want to foreclose. Contrary to what people believe, banks, it's costly for them. It's time consuming. It takes both staff and paid attorneys. It's not a process they want to go through. And so they're more likely to work with the homeowner if they're in some sort of financial hardship. Most of the times it's the homeowners who aren't communicating with the lender, right? So, or the servicer. So we want to make sure that, 30, 60, 90 days, there's a whole process to foreclosure. This coming Thursday, we're going to talk about financial resiliency and working with with our homeowners on foreclosure prevention, on retention, and making sure that they can, figure out a way to save and stay in their home. So here's a list of resources. Of course, the consumer finance. What I like about this particular closing disclosure is that it's interactive. So your clients can actually click on different parts and it'll explain certain things to them. Ameren Risk is an insurance provider, native-owned insurance provider. And so I always want to shout out to them because they typically come out and provide us with more information. A lot of this content, I lean on First Tribal Lending because just happens to be the lender that I work with the most. And so this is their contact information in case you wanted a specific person to communicate with. I know Adam is available and willing to connect with anybody who wants that information. But as I said before, there's a list of approved Section 184 lenders, and you can definitely utilize the list to make sure they're in your area and they work with clients within your area. I will say you don't want your clients. You never want somebody to be their learning curve, right? Not that I don't trust, new loan officers, but, I want it to be local. I want it to be someone who's familiar with your tribe, familiar with your land situation, and someone who's closed loans before. So those are the types of questions they should be asking. How many Section 184 loans has your organization closed? And when I say organization, I should say financial institution. It's just hard to kind of interchange the two. I talk about so many different organizations. Anyway, any questions? I know I kind of neglected the chat area there for a little bit. I'll try to get to the ones that I missed. Awista, if I could have your help with that. Here's my contact information, my email address, the other trainings I provide. And of course, thank you for just listening, taking time to hear more about Section 184. I think we're good on time. I'll just answer any other questions I have. Let's see here. I think the last thing I discussed was contingency. Are there loan down payment assistance? I talked about that. Does the person getting the loan have to reside in the home? Yes. So in the case of Section 184, they do need to be primary residents. You have to be in the home. It's not an instrument for investment. Now, as I said, with the types of units, you could potentially put a duplex, but one of those units has to be the borrower's primary residence. So for a single family home, the person has to be in the home. If it's more than one unit, they need to be in one of those units in order to qualify. Hopefully that answers your question, Aaron. And then let's see here. So yeah, Robin has more of a hobby than a business. And a lot of Native communities, jewelry and other sorts of selling at powwows, etc. So that's totally understandable. So it's not that you would get dinged. I guess what I'm trying to convey is that there's just a lot of individuals who don't show any income. And if that's the case, then it just isn't something that can be used to apply to their DTI, right? That income, obviously if you had, you're not having to pay out a whole lot, or if you do it, you're paying it out after each year. You're not rolling it over, right? Those expenses. So I would say as long as you show proof that you're paying that each year, and it's not an issue, it just means that income you don't have any income to show. Let's say the homes in your area are anywhere between 250 and 300. Well, depending on how much income you show, you might not have enough to be able to qualify for 250 or 300 if all you have are expenses. Now, because this is a hobby, it's a different beast. It doesn't affect you. But if you need that income, need to show that income in order to qualify, then that's a different circumstance. Sure. You're welcome. You're welcome. And it's fine that it shows up on your tax return. As I said before, I don't think it's an issue as long as it's not your primary source of income. Now, moving forward, you might want to show more of a profit if you think that it'll help you increase how much home you can afford, right? You want to go from 250, because as a realtor, I can tell you that there's a huge difference between a home that's 250 and 300 in today's market, right? So, if you need to get there, if you need to get to that 300 mark, then that extra income would be helpful. So Tara says, yeah, so Robin says it's not our main income. So that's good. So yes, a native and non-native can be on the same home loan. This goes back to the tribal lease itself. Like, so you as the enrolled member would be the one on the land lease. And so that's how that part works. But as far as the home loan itself, you both can be on the home loan. Just depends on, your tribe and their requirements. Yeah, no problem. I think I've got everybody's questions. Again, thank you very much. I really appreciate this time with you all. I'll be back on Thursday to talk about foreclosure prevention and how we can protect this investment as much as possible. As you can see, the process is so lengthy that we want to protect folks who have already gone through it.
Thank you so much, Marie. Greatly appreciate it. You did a wonderful job.
Thank you.
I'm going to launch today's survey. Please let us know what you thought of today's webinar. This information greatly helps Marie. It lets her know what you would like to know more of, what subject she can touch up a little more next time. It also helps us know how we can improve. So we greatly appreciate that. Our next webinar is going to be tomorrow, 2 p.m. EST, 1 p.m. Central, 12 p.m. Mountain, and 11 a.m. Pacific. It is going to be protecting Native American communities from scams, presented by Emma Fletcher and Rosario Mendez from the FTC. Feel free to access this and any other recorded webinars online on our website at www.nativelearningcenter.com. We have a Cathedra webinars tab in a recorded webinars section. You can click on any one of the webinars that we have done for the past 18 months. Feel free to view them and share them with your friends and colleagues.
Hey, Oista?
Yeah.
I got to thinking about the question about down payment assistance, and I did want to say, if there's anyone in the areas of Minnesota, North Dakota, and South Dakota, there is currently a grant. It's for individuals, so not a community, but an individual can apply through, and the dynamics surrounding the grant, the link is there, but it's through Indian Collective, and it's called Collective Abundance. And there's pretty extensive grant. It's $25,000 and $50,000 increments, and it can be used for down payment assistance, or not assistance, but down payments. It could be used for rehab on a home. As you write the grant, you're writing it for perspective of how can this support or increase Indigenous wealth. And so that's what this grant is meant to do. So I just wanted to put that out there. I put the link in the chat area, but thanks.
Of course. Thank you for mentioning that. Check out our upcoming events as well on our social media sites such as Facebook, Instagram, Twitter, and LinkedIn. We even have a podcast titled Hope a Thing, a Native American Podcast. You can find that on Simplecast, Google Podcast, Spotify, and Apple Podcast. Once again, thank you everybody for joining us today, and thank you, Marie. You did a wonderful job. Tune in tomorrow for our next webinar. I hope everybody has a wonderful day.